Welcome to this explainer. So you've got a little money saved up, right? But the second you think about investing it, you just freeze up. There's way too much conflicting advice out there. Well, I'm going to be your mentor today. We are going to totally demystify this whole process. We're building a simple, completely automated roadmap specifically for young professionals like you, showing you exactly how to start, literally right now with whatever limited savings you have.
Here's our agenda for this explainer. We're going to cover the silent wealth killer, the index fund advantage, surviving market crashes, your brokerage setup checklist, and finally, the fast lane strategy. Let's dive right in.
Section 1. The silent wealth killer.
So, let's say you've been super responsible. You've saved up a few $1,000s. You're probably feeling pretty good about it, right? You should. But here's the catch. Leaving that cash sitting completely idle in a standard bank account, where it's earning what, maybe a couple pennies a year, is actually a losing game. The culprit? Inflation. Your money is literally losing its purchasing power every single day. Think about it. $1,000 today buys you way less stuff than it did 10 or 20 years ago. The physical $1,000 is the same, sure, but because the cost of living keeps going up, your idle cash is actually shrinking in value behind the scenes.
So how do we fight back? We have to deploy the exact opposite force. We're talking about compounding interest. Albert Einstein actually supposedly called this the eighth wonder of the world, and for good reason. The entire point of investing is to put your money into an asset that generates more money, outpaces inflation, and just compounds over time. It is absolutely crucial. It's the primary engine for long-term wealth growth, and honestly, the ultimate vehicle for turning your existing cash into lasting wealth.
Moving on to Section 2, the index fund advantage.
Now, you might be wondering, how do we actually access this incredible compounding power without the terrifying stress of trying to pick the right stocks? Well, instead of gambling your hard-earned cash on a single company, the absolute smartest move is to buy an index fund. Think of an index fund kind of like a self-healing best of Spotify playlist, but for the stock market. You're pooling your money to automatically own a tiny piece of literally everything in that specific index.
Let's look at the famous US S&P 500 index as an example. When you buy into an S&P 500 index fund, your money gets automatically distributed among the top 500 biggest companies in the US, weighted by their size. So your investment is instantly split up. You'd hold about 7.18% in NVIDIA, maybe 6% in Apple, 4% in Microsoft, all the way down to company number 498, which is Match Group, the company that owns Tinder, at 0.01%. Boom, you essentially own the whole market in one single click.
Okay, so why not just buy Apple or NVIDIA stock directly and call it a day? Because historically, my friend, even companies that seem too big to fail can absolutely collapse. I mean, look at Kodak. They literally invented the digital camera in 1975, but still filed for bankruptcy in 2012. Or Blockbuster. They laughed at the chance to buy Netflix for $50 million, and now only one physical store exists on the entire planet. And don't forget 2008, when the 158-year-old investment bank Lehman Brothers completely collapsed in a single weekend. If you bet everything on one seemingly invincible company, you can lose the whole shebang overnight. That is exactly why even the full-time Wall Street pros working 80 hours a week struggle to beat the index.
Now, if you're a bit worried about all your eggs being in the US basket, you don't even have to stick to just the US index. For ultimate risk management, compare the S&P 500 with a global index fund. While the S&P 500 holds 500 U.S. companies, something like the Vanguard Global Index Fund holds around 3,700 companies spread across 49 different countries. So yes, you get Apple and Microsoft, but you also get Samsung in South Korea, TSMC in Taiwan, and Toyota in Japan. Your wealth just naturally grows wherever the global economy thrives, adjusting on autopilot to wherever value is being created in the world.
All right, Section 3, surviving market crashes.
So spreading your bets across the globe is great, but it doesn't mean the market never goes down. The fear of losing everything in a crash is totally valid. But let's look at the terrifying COVID-19 crash. Imagine you invested $1,000 at literally the absolute worst time, early 2020. By March, the market drops 34%, and your money is suddenly worth only $660. Ouch. If you panic and sell right then, you permanently lock in that loss. But think of a market crash like a massive, global Black Friday sale on the world's greatest companies. If you just hold tight, or better yet, buy more while it's on a discount, by the end of 2021, you'd have $1,400. And by the end of 2025, that initial $1,000 would have more than doubled to over $2,100.
Seriously, as long as you don't panic, temporary crashes are just incredible buying opportunities for the patient investor. And you might be asking, why is the long-term trajectory always up?
While it boils down to two simple things: human productivity and population growth. Every single day, thousands of people go to work at these companies to innovate, build, and create real value. At the same time, the global population is constantly expanding. That means more consumers entering the economy, buying phones, paying for subscriptions, you name it. These two fundamental truths virtually guarantee long-term value creation.
Let's get practical. Section 4. Your brokerage setup checklist.
Okay, it is time to translate all this theory into an actual real-world action plan. You need a middleman, an online stockbroker, to actually buy these low-cost index funds. When you're picking your platform, just use this simple checklist to remove all the friction. 1. Make sure it's completely free with zero commissions. 2. Ensure it allows fractional shares. That means you can buy a tiny fraction of an expensive stock without needing hundreds of dollars up front. And 3. Make sure it offers an auto-invest feature. I promise you, setting this up takes less than 30 minutes. Here is the exact timeline. Step 1. Sign up for that free platform. Step 2. Fund your account with whatever you can comfortably afford right now. Honestly, even if it's just $10. Step 3. Set an auto-invest schedule so your money deposits into an initial index fund automatically every single month. Literally set it and forget it. You have just built a completely passive, self-rebalancing portfolio.
Finally, Section 5, the fast lane strategy.
Now, what if you don't want to wait 40 years to become wealthy? What if you want to see significant returns in, say, 5 to 10 years? We need to starkly contrast two different paths here. The slow lane is what we just talked about. Passive index returns averaging a steady 7 to 9% annually. It's safe, requires zero effort, and is highly recommended. But then there's the fast lane. This is where you get massive, rapid returns by investing in your own personal skills or starting a business. Now, this lane requires intense personal effort and comes with a much higher risk of failure compared to standard passive index investing. You're basically trading guaranteed slow growth for riskier but potentially massive upside.
Let's put that into perspective. If you have $1,000 and put it in the S&P 500, you might make about $70 in a year. Nice, but it's not life-changing. But what if you use that $1,000 to buy a certification course? Say you're currently a healthcare assistant making $15 an hour. You take this course to become a phlebotomist, and boom, suddenly you're making $30 an hour. You have instantly doubled your earning capacity. In just 2 weeks of full-time work, you've completely earned back that initial $1,000 investment, and from then on out, it is pure profit. It's the same logic with starting a lifestyle business. A small upfront investment can yield a 10x or even a 100x return in just a few years. That is something even a massive giant like Apple simply cannot do for you.
Truthfully, the absolute best roadmap usually combines both of these lanes. You invest your time, your energy, and a little capital into the fast lane to aggressively boost your income today, and then automatically funnel those increased earnings right into the slow lane of index funds to quietly compound in the background for tomorrow. So, as we wrap up this explainer, you've got a choice to make. You have the exact blueprint, and you know it takes less than 30 minutes to get the ball rolling. Are you going to let inflation silently steal your money, or are you going to take the wheel and secure your financial future right now?